Hey, this is Jake Hoskins here. Thanks for tuning in to this week's video. I'm going to be talking about when stocks fall, what you should be doing, how you should be handling it. When you're investing in the stock market, sometimes the most difficult thing, at least the most difficult thing for me to deal with, is when stocks start going down. And you have to be incredibly disciplined. But if you're a really disciplined investor, you can take advantage of this and make a lot of money when other people are losing money. In my opinion, this is the most crucial time, when the great investors separate themselves from the day traders and the people with the lousy returns. So there's basically two things that can happen when your stocks start going down. Number one, you can panic sell at the bottom, and a lot of people do this, and that makes you pretty much the same as any other average Joe, day trader out there. But we're long-term investors, and so we don't want to panic. We want to make long-term returns that are better than everybody else's. And the way you do that is by being smart, being disciplined, and know that when stocks start going down, it's normal, and it's a big opportunity for you to get in at cheaper prices. When the market starts going down, it can be really stressful. You need to be disciplined, and you need to have a structured approach into how to think about these situations, because if you just act purely on emotion, you're going to do the exact wrong thing, because our psychology as humans is basically rigged to do the exact opposite of what we should be doing in the stock market. Because when a stock goes down, we're usually scared. That's the normal emotion. But we should be out bargain shopping on these stocks and getting them at better prices. But then when stocks start going up, we get this false sense of accomplishment and this false sense of security that they'll always go up, and so we end up buying more, and a lot of times we end up buying at the top of the market, and that's obviously the worst thing that you can do, because they can only go down from there. So let's get into my structured approach of how I handle falling stocks, and how you can use this as well to take advantage and to increase your returns in the stock market. Before we get started, go down and like the video and click subscribe so you don't miss out on future videos like this one. So let's get started with the 5 questions that I ask myself when my investments start going down. And keep in mind, this is for long-term investors only. That's all I do. I'm not a day trader or anything like that, and you shouldn't be either. Keep that in mind when you're considering these rules. This is only for long-term investors, and that's what you should be doing. So the first question you should ask yourself is, why did I invest in this company in the first place? And go back to your fundamentals, whether it was a week ago, a day ago, or 10 years ago when you first invested into this stock. Think about, at the very fundamental level, why did I invest in this stock over the hundreds of others that are out there that I could have invested in? Maybe you thought this company was the technology leader, the clear leader in their industry. Maybe you thought that they were small and the company was mispriced, and you thought that the stock price should go up to compensate for that. Whatever that reason was, is that fundamental reason still intact today? And if it is, you have to just kind of hold out. When your stocks start going down, it should be a good thing. If nothing has fundamentally changed and you still believe in the company, you should only be buying more when the stock goes down, because it's like when you go to the grocery store and something goes on sale that you buy anyway, you just buy more of it. You're happy that the price went down. So that's how you should be thinking about falling stocks if nothing has fundamentally changed. Okay, the second question that I ask myself is, why did the stock go down? And this, in most cases, is just bad news. Maybe something bad was said about the company. Maybe they had a bad quarterly report. Maybe it came out that some big investor has shorted the stock and they think it's going to go down. And so you kind of have to do some soul searching there and say, okay, is this short-term bad news that people are overreacting to? And in most cases, that is what happens. And usually just bad news, short-term bad news, is what makes a stock go down really quickly, like 3 or 4% in a day. But if a stock is deteriorating over months or years, you really have to look deeper and think, is there something that I'm missing here that everybody else is seeing, and they're selling their stock, but I'm holding on to mine? But usually it's really nice when there's just a little bit of temporary bad news that doesn't really affect the long-term outlook of the company, because the price goes down a little bit and you get more shares at a lower price. But you have to be careful and not skip over any sort of changes that may have permanently damaged the company's ability to earn money and to grow in the future. And so this leads me right into the third question that I asked myself: has something changed? Has something fundamentally changed in how this company does business? Is there more competition that the business is facing? Are they changing their business model? Are customers not wanting to pay as much? I would recommend to go through and maybe just jot down a few ideas as to why the stock has been going down. Could this be permanent? What is the biggest risk that you see in this company? Just write a few of those down and then really think through them in a non-biased way, so that way you can make a better decision as to what to do with this stock long term. And I'll just say from my experience, if you've done the research up front, I would say 8 times out of 10, you're just going to hold the stock and you're probably going to buy more. But there are certain cases, again, I can't overstate this enough, where you missed something in your research at the beginning before you bought the stock, and it's kind of coming to fruition now, and you need to get out. So just always be second guessing yourself, but at the same time kind of be confident and make sure you do as much thorough research up front as you can. So the fourth question that I ask myself when my investments are going down is there something better? So we have a limited amount of money, and so we can only buy so many things. Of course, we want to own the best of the best stocks, the ones that we think are going to grow at the fastest rate over like 5 or 10 years. And so I'd say that this is probably the number one reason that I sell stocks. I don't sell many stocks, but in the very few cases that I have sold a stock, it's usually because I find something that's better, something that I believe is going to grow faster than the company that I'm holding now, where my money is sitting right now. When you do this, just keep a check on yourself, because if you're doing this 2 or 3 times a week, odds are you're just panicking and you're convincing yourself that something's better and you're letting your emotions get a hold of you. It's not going to be that often that you find something else that's clearly better than where your money is right now and you need to immediately sell. But there will be a few times here and there, and those can be very key decisions for you and your returns and making money. So the last question that you want to ask yourself is, what does my portfolio look like? And do I have enough cash? You have your collection of stocks that you own, and maybe you have a ton of money in one and the price is going down, and that can be a really tricky thing to deal with. And I'll say that you don't have to sell your entire position in a stock. A pretty good way to manage risk is just to sell a little bit of your stock. If you have a ton of money in one stock, you're worried that the price might go down, maybe it's ran up a lot, and you want to take some profits off the table and just reduce your allocation in that stock and reduce your risk. That's a good thing to do. And so maybe you sell 10 or 20% of that holding. Again, that's a pretty good risk management thing And like I said, in a lot of cases, if you're not just saving cash, you have to go sell something to buy something else. But it's really convenient if you do have cash just sitting in your account that you can buy something with. And that's not a bad idea to have maybe 10 or 20% of your investing account in cash. That way, if you get a really big dip in the market, you can buy at the bottom. You don't have to sell anything to buy something else. And my favorite method to kind of sidestep all of these questions and decisions that have to be made is just called dollar cost averaging, where most of us have a job where we get paid every week or every 2 weeks. So we get our paycheck and we put in a certain amount of our paycheck into our investments every 2 weeks. When we're buying with the same amount of money every period, we get less stocks when the stocks are higher, and we get more shares when the price is lower. So that's just kind of a good way to automate, and so you don't have to be super disciplined and figure out when to buy and sell and all of that. So I want to reiterate again, stocks going down is a normal thing for the market. It happens in cycles a lot of times, and it's just a normal thing that separates the great investors that have 10, 15, 20% returns from the investors that lose money and that are constantly losing their mind. And so we want to be those smart investors that take advantage of market dips, and so we can get more shares at cheaper prices and make more money. But when those numbers start going negative and there's a lot of red on your screen, it can be hard to deal with. And so just remember these 5 questions that I talked about here, write them down on a piece of paper, and just keep these 5 questions on your desk. So whenever you see a big market dip, just go through those questions, re-examine your fundamentals, and if the fundamentals are still good, and you should do really good investing in the stock market if you have that kind of behavior pattern. Thanks for watching to the end of the video. I want to thank you for tuning in and thank you for your support. Again, click subscribe and click like to really help me out. And I'll be making more videos like this in the future. Thanks.